Hello and welcome to the Tax Roundup for May 2014, and it's budget month. I know you're all desperately excited by that in the middle of your lodgement deadlines. If you're on our email mailing list, we'll send you a copy of our budget update the morning after the budget. This is the update specifically for accountants and advisors. If you're not on our email list, then you can download it from our website. Now, with the Commission of Audit releasing its report on 1 May, we'll be looking to see whether, in the budget, the government introduces the wide-ranging structural reform recommended by the Commission, or just seeks to trim around the edges. Now, the Commission's recommendations are significant and fundamentally rework access to a number of government benefits, the age pension, healthcare, family benefits, but they also look to restructure the government departments themselves and how they deliver services. While all this has been going on, the ATO have been very busy. Mike Carruthers takes you through the contact your building and construction clients are getting right now from the ATO.
Now, you might start receiving calls from clients who've received letters from the ATO asking them to make sure that they're lodging their building and construction industry payment reports. Now, these rules have been around for a couple of years now, but the ATO is certainly starting to crack down in this area, make sure that people are complying with their requirements. The reports will be due by 21st of July 2014 for the 2014 income year. So it's probably just a matter of making sure that clients are aware of what their obligations are, what sort of information they need to have on hand to be able to get those reports filled out and lodged with the ATO on time. Now, very quick rundown on how the rules work. Basically, if your client is operating primarily in the building and construction industry, so that's 50% or more of their business income comes from building and construction services, or half or more of their business activities relate to the building and construction industry and services, then they are required to lodge this report with the ATO, setting out details of the payments they are making to other entities in respect of building and construction services. So name, ABN, payment details. It's done on a cash basis, so you don't need to worry about accrued amounts that haven't actually been paid. Try and simplify things a little bit, but it is important to make sure those obligations are being met because the ATO really will be looking at this in detail this year. Now, if you believe that your client doesn't actually need to lodge one of these reports because they don't fall within the building and construction services industry, or at least in the definition for the purpose of these rules, then you can actually just send an email to the ATO. The email address is in our tax roundup for this month, and you can just let the ATO know that there's no report required for the client. There is no obligation to lodge a nil report. If the client doesn't need to lodge a report, you don't have to lodge a report. But just to get the ATO off your client's back, good idea to send that email through to the ATO, and that should hopefully put an end to it, unless the ATO believes that they actually do have an obligation. So just a reminder that those letters will be going out to clients. They'll probably start asking you about it, maybe time to get on the front foot, and make sure that clients are aware of their obligations.
A determination released last month from the ATO gives some clarity for self-managed super funds on the use of sub-bank accounts and whether these meet the segregated current pension asset requirements. Garth McNally explains.
The ATO have recently finalised a draft tax determination that was initially released in August of 2013. This draft determination and the new final tax determination specifically deals with bank accounts in regards to segregated pension accounts inside a superannuation fund. It's also interesting to note that the final tax determination deals only with bank accounts inside the super fund. The initial draft determination dealt with segregation of other assets as well as bank accounts within the fund. So the new one is only specific to bank accounts inside the fund. We may get further clarification from the ATO on other assets sometime in the future. The final determination seems to have come from a real practical point of view from the ATO. When I say that, I mean that the ATO has looked at bank accounts inside a fund and decided that a bank account, a single bank account inside a fund, could actually be broken up into different sub-accounts. So a single bank account could actually be made up of both sub-accounts that contain one account of pension assets and one account of accumulation assets. I'm not aware of too many financial institutions in the marketplace today that actually have a financial product which has a bank account with sub-accounts. So from a practical practical point of view, how these sub-accounts will really work from a day-to-day application for a fund will probably be through the accountant or the fund administrator taking that one bank account and then manually creating sub-accounts within their accounting software. It could be that some software providers will manage that for us with updates going forward, but currently it probably will require the accountant to manually enter the transactions and breaking up those transactions into the sub-accounts within each self-managed super fund. Another point to note is there's been a fair bit of hype around this tax determination, this final one, TD 2014/7. In my dealings with the accounting network, I'm actually not aware of all that many accountants who regularly use segregation for their funds. Some do for maybe one or two funds in their practice, but I'm not aware of many accountants who apply segregated assets across their client base. So this final determination may not have a huge application to many funds that we deal with on a day-to-day basis. The outcome from this determination is that really that each sub-account within the self-managed fund can be treated as a segregated pension asset. The one account broken into sub-accounts, each sub-account could be treated as being a segregated pension asset. Another practical point to be aware of is that if there's one bank account, and let's just say there's a $1,000 bank account, of which $300 is in sub-account 1 for an accumulation member and $700 is in sub-account 2 for a pension member, that one account will earn interests. That one account will have expenses incurred on that account, such as bank fees or expenses paid on behalf of the fund from the one account. So what that will require is the accountant to apportion income between those sub-accounts, and of course that apportionment will need to be calculated manually until such time as software providers provide the solution for the accountants.
Do you remember in past tax roundups where we told you that the ATO never loses cases on the contractor versus employee issue for super guarantee? Well, now they have. Mike Carruthers explains.
Now, you might remember that towards the end of last year, we gave an update on a case that went through the AAT dealing with SG, once again, a lot of cases in this area at the moment, and it was regarding a commercial fishing vessel and whether the crew members on the vessel were employees for SG purposes. Now, in that situation, the ATO won and the crew members were deemed to be employees for SG purposes, so there was an obligation to make superannuation guarantee payments. That was the floor play case, make sure I get that right. Now, the current month we've seen another case go through the AAT, again really interesting name, Dominic B Fishing Proprietary Limited and the Commissioner. Seems like fishing businesses have much more interesting names than accounting firms, but we're seeing actually for once the Commissioner losing on an SG issue. So in this case the AAT actually held that the crew members working on the vessel were not actually employees of the vessel operator. Now, I'm not going to go through the detailed facts, but what the AAT found was that the parties involved in this arrangement were actually joint venture partners. They were sharing effectively profit from the catch that they made during each trip. Basically what happened is if the crew member didn't actually catch fish, well, they didn't get paid. So it's very much a results-based arrangement. Theoretically, if they didn't catch any fish, they would actually go back to port owing money to the person operating the fishing vessel. So the AAT in this case, based on the arrangement, based on the facts and circumstances, actually held that the crew members weren't employees. There was no obligation to make super guarantee contributions on their behalf. Now, the other interesting point made by the AAT in this case, right up at the front, was that they recognised that there are actually quite a few people, particularly in the fishing industry, keeping a close eye on this particular case, just to see where it fell, because if the taxpayer won, well, that would give a good indication on how arrangements should be structured in the future to avoid SG obligations. Worth pointing out, the AAT made a very, very clear point that you can never generalise in these cases. Always based on the facts and circumstances. Just because the taxpayers won in this case and there was no employee relationship doesn't automatically mean you can go ahead and make your situation look like this to get around the SG issue. need to pay particular careful attention to the facts and circumstances, work through all the indicators of the employee versus contractor divide, and really make a considered judgment. So, good case in terms of those who are seeing, I guess, a lot of ATO wins on the SG issue where they, there's been all this confusion around where is the employee contractor divide. But just that warning, take care, don't generalise. Just because there's a win in this case doesn't mean that you can just kind of take that decision and apply it to your facts. You need to apply the law, the guidance to the facts in every case.
And that's the tax roundup for this month. Don't forget the end of the financial year is almost upon us. If you don't want to go through the process of updating all your checklists, standards, procedures and everything else that you have on file, then why not have a look at what Knowledge Shop members can access on the Knowledge Bank? It just doesn't make sense for practitioners all around the country to be attempting to update everything that they have for 1 July when they can just get it off us. Why not give Ray a call on 1800 800 232 and have a look at what we have to offer. See you next month.